We met Hugh almost 8 years ago when we were on with our buddy Frank Pastore. And Frank said some nice things, and Hugh agreed to meet with us. We had lunch at Gulliver's. Where else would we have lunch? We had the meat, as you would expect. And Hugh was asking us, well, what is applied financial planning? What's this LPL? What are you guys talking about on independent, unbiased, conflict-free advice? And within about the first 5 minutes, he got it. He totally understood where we were coming from. It took us another couple of years to finally figure out how we could get on his show, and so he could say something nice about us. And thank you for saying things nice about us. And we've been with Hugh now. We're coming up on our 6th year. It's been a great relationship. Many of you are listening to Hugh. Some of you listen to our buddy Frank Pastore, now listening to Frank Sontag. Keep listening. There's just a lot of information that comes out every day. What we really love about Hugh is he is a political, dare I say, a genius. He knows most of the people on the Hill. He worked on the Hill. He was in the Reagan White House. And so when you have questions of a political nature, make sure you're listening and call in, talk to Dwayne, say, Dwayne, it's a political question, you'll get through. Okay, if you want to talk about the weather, you're going to hang up on you. So with that, Hugh, please come up and tell us what you see about the elections.
Thank you, Bill. There it is. Bill is absolutely right. These guys have been my pals for a long time. And it began with just O'Connor and Mike Cohn. And I call my friends by their last names, right? So that's what it was, just originally O'Connor and Mike Cohn. Then they brought in Sean and Bernardo and Marcelo and all these different people showing up, and I got to know each of them in turn. And Sean's a jet pilot, and he's a fighter pilot, and I stood up because I have a son-in-law who's a fighter pilot. So he always fills me in on fighter pilot stuff, and I just really connected with them at every level. So I played a practical joke on him this year. I don't do anything for free. I'm a complete mercenary, right? I believe in capitalism. So if somebody asks me to speak somewhere, I always say, well, what's the honorarium? And they tell me the number. So Fred, who runs the accounts, said the money guys would like you to come out for the post-election wrap-up when they do their asset reallocation advice. And I had played a little joke. I said, what's the honorarium? And they came back with a healthy number. And I said, okay, tell them I don't want it. I want to do these guys a favor because they've done so well by so many of you for so many years. So I'm actually here for free today because I really believe in these guys. Now, I tell you that, and I tell you that because Prager and I are so adamant about this. We don't endorse people we don't believe in. I'm not here because they paid me to be here, and I'm not here because they're on the radio with me. They're on the radio with me because I trust them. And so if you need advice, it's my pitch for them. I think they're ethical, they are believers, they are cautious, and they are comprehensive. They are also that keyword independent. Now, they didn't know I was saying any of this stuff. They just thought I was going to come out and do politics, which I'm about to do. But that independent is the key deal, right? When you're independent. I got to tell you my Cohn story. How smart are these people? I've known O'Connor smart for a long, long time because you can't have all the various licenses he has without being smart. He's an insurance guy as well as all this other stuff. And the insurance part is so complicated, it's becoming increasingly impossible to understand relative to the tax code. And I may ask Bill the first question. I really do not understand how you can do tax planning when the Ways and Means Committee announces they want to do a tax rewrite. It's really one of the most dangerous times for people who have allocated assets into deductible functions, which is why I always yell at Paul Ryan. And he's a good friend. I've yelled at him twice when he cut the pensions of military people who had served more than 20 years. I yelled at him on the air. And the second time is when the chairman, I haven't yelled at him, I'm having stiff conversations with him when they want to threaten the home mortgage interest deduction, because I think reliance has existed in America on that deduction for more than 40 years. People have ordered their lives based on that, and they've moved places based upon the assumption of state income tax deductibility. I don't know what we're going to do in California if state income tax deductibility goes away. It's like an enormous reset of your wealth. So these are things that Bill and Marcelo and Sean and the gang have to talk to you about when when I'm done talking, but it's a period of extraordinary volatility. But I have to tell you my Cone story. So Robert goes on this cruise with me, and we went to Spain and Portugal. And he kept offering to teach me how to play bridge. It's like Scott offers to teach me how to shoot. I don't know how to shoot. Scott's a trained, expert marksman, served, knows his way around the military, knows his way around armaments, wants to teach me how to shoot. I don't know how to shoot. I'm afraid I'd shoot my foot off. And I am not particularly coordinated, perhaps the opposite. And so and bridge, just counterintuitive to me. My Cone in 5 minutes taught me bridge. It was really remarkable. He sat down. He has a system for doing it. He's a grandmaster or a super grandmaster or a double, triple grandmaster, grandmaster. And so it was fun. And so he's coming again on the July 22nd cruise. So I'm going to get my second bridge lesson, and then I'll forget it all again. But they're really smart. It takes math to play bridge. It's like counting cards in Las Vegas. So I've given my testimonial. You can trust these people. Now let me give you the bad news. You need these people. Why do I say that? After every election, I do talk with my law partners about the changed environment, because we represent a lot of people who have significant regulatory interests that have to do with what is the SEC going to do, what is the IRS going to do, what is the U.S. Fish and Wildlife Service going to do, what is the EPA going to do. We have a government relations practice, and I'm deeply involved in that, and I listen. And I have a journalism world. I have 3 worlds. I teach, I practice law, and I broadcast. And nobody knows. People who have been around Washington, D.C. for 40 years have no idea what's coming, because the president is lawless. Right? So we've always been able to count upon a president who acted within the norm of minority party president. We've had that quite a lot. You know, Nixon spent all of his presidency, as did Ford, as a minority party president, meaning he controlled neither House of Congress. Clinton spent 6 of his 8 years as a minority party president, controlling neither House of Congress. Reagan spent 8 years as a minority party president, meaning he only controlled 1 House of Congress. So we're very used to this. The norm, the abnormal situation is 2009 and 10, when the president enjoys supermajorities. That was the rare thing, and it brought us really bad legislation in the form of the stimulus, Obamacare, and Dodd-Frank. So one-party control of Washington is really bad, but we've never had a president who is manifestly contemptuous of the constitutional limits on his office. Some people say that Nixon was that way. That's not true. And I worked for President Nixon 1978 to 1980, again from 1988 through 1991, when the library was being built not far from here. Nixon's problems were with the criminal law, with the law of obstruction of justice, not with the constitutional law. Constitutional law, he immediately turned over the tapes upon being directed to do so. He did obstruct justice. I don't think there's any denying that. He accepted the pardon. He was afraid of that. And he made some huge mistakes, but they weren't constitutional mistakes. When he sequestered money and the court ruled that that was unconstitutional, he immediately stopped sequestering money. Contrast that with Hobby Lobby, which wins a big Supreme Court case, and that big Supreme Court case results in Hobby Lobby being told they don't have to buy the Obamacare contraceptive mandate. And just this week, the federal government issued regulations which clearly are intended to make Hobby Lobby pay for the contraception mandate. In other words, they refused to lose. They said, well, you won the last, it was a technical win. It wasn't a technical win. It was a sweeping constitutional authoritative decision by the highest court in the land, and the Obama administration isn't going to pay attention to it. The immigration speech on Thursday night, if you read my website, I got up early this morning because I wanted to write this at hughhewitt.com, was breathtaking for a con law lawyer. That's what I do. That's what I advise people on. It's environmental law and constitutional law. And it's breathtaking because there is no precedent for what he did. Now, our media is pretty stupid. I don't mean malignant. I mean just not very bright. And they are easily misled by the assertions that the president made in his speech. He made two in particular. He said he was exercising prosecutorial discretion, which is inherent in his office. That is partially true. Everybody has prosecutorial discretion. Tony Rackauckus, who's the district attorney in Orange, has prosecutorial discretion. I'll tell you a quick story. I called up a DA of a jurisdiction once on behalf of a friend of mine, and that friend of mine, who has a significantly disabled child, was going through the TSA line, and there was discovered in his bag an empty magazine. That's it. No gun, no bullets in the magazine, nothing. It is against TSA regulations to have an empty magazine in your luggage that you carry on. How many knew that, by the way? You can't have an empty magazine. His son had been playing with the trash into which this empty magazine had been put, and had put the empty magazine into his gym bag, and so he went through. And so he was charged with possession of an unlawful object. It's not a gun. It's an empty magazine. I don't even know what a magazine looks like. It fits into his handgun. So I called up the DA, and I said, do you realize this guy's got a developmentally disabled son who was obviously playing with an empty magazine and put it in his gym bag, and it's an empty magazine, and here's this guy's, he's on every board of directors of every charity you could ever imagine. I said, this is just wrong. And the prosecutor dropped the case. He'd been charged because they don't have any discretion at the TSA stand. Prosecutor dropped the case. He said, oh, you're right. We won't be bringing that. You didn't even have to call me. When that got up far enough, we would have dismissed that. And I said, I know, but nobody likes to have a charge hanging over their head. And so prosecutorial discretion is a real thing. I have been in front of the Department of Justice many times and in front of many administrative agencies arguing for prosecutorial discretion. I've got a partner, Judge Stephen Larson, former federal judge. There are very few of these guys in practice. And Larson gets called in all the time by people in deep trouble, and he goes in and he argues for prosecutorial discretion on a case-by-case basis. You go in and you argue to the Bureau or to the Secret Service or to this or to that. My client is different. Exercise your discretion. Don't throw the book at him. Every day, if you've ever walked into Orange County Court, prosecutorial discretion is flying around left and right. They're charging, not charging, dismissing, settling. The president has a lot of prosecutorial discretion. It has never been exercised categorically or on this scale. All right, so that's number one. You will hear the left argue that there are precedents for what happened in actions by President Reagan and President George Herbert Walker Bush. Those have been examined with particularity, and they are not applicable. In the first instance, there was an oversight in the 1986 Act. So a law was passed in which there was an oversight, a genuine typo, not the sort of typo that is alleged to have existed in the ACA that Dr. Gruber has proven to us. They forgot about a category of people, and President Reagan waved in 200,000 people who would have been included in that law, which did pass, had they written it a little bit more carefully. Very different from the ACA situation, very different from what happened. 200,000 people, also very different from 5 million people. The second set of wave-ins that have occurred, executive amnesty, have not been amnesty at all, but have been exercises of the authority in the law to allow people to stay whose return would be to a country in which their physical safety would be endangered in a specific way. So we don't send people back to Cambodia when the genocide is going on. And we don't send people back to Somalia. Or we exercise this. We have laws, and that's an exercise of legal authority. What the president did was not prosecutorial discretion in terms of magnitude. It was not precedented in terms of what happened. But even if it was, and even if it had been, this is the classic, it's not my dog, it didn't bite you, besides you kicked it first. Even if it had been truly prosecutorial discretion, and even if there had been precedent for anything remotely like this, and it's no and no, he did something else, which the media won't focus on. he created an affirmative work permit. That is positive law. He invented that. He is sending out pieces of paper for which there is no legal authority. It does not exist, that purport to allow people in the country illegally to work. Now, in fact, if you hire someone who's in the country who's not here legally, and you do so knowingly, you are violating the law and should be fined. And that is why, by the way, Meg Whitman is not governor of California, because she hired a person who was not in the country legally and looked the other way at that. And Gloria Allred outed that woman 6 weeks before the election. It became an issue of hypocrisy. Her numbers plummeted because you can't hire. It's the nanny problem. You can't have an undocumented alien as a nanny. The president is purporting to issue pieces of paper to 5 million people that allow them to work. He could, at the outside of his authority, I still think it's unconstitutional, say I'm not going to prosecute 5 million people. It would be unprecedented and unconstitutional. But the idea of creating a law out of whole cloth is simply unconstitutional. It's an attack on the idea of the rule of law. Now, why should that worry you? I've always laughed at people who said the president is going to tax your 401k. I've always laughed at the people who have said that the president is going to do this or that that's just wildly outside of the rule of law. And I've just never thought that. I've always thought him restrained by the rule of law. But this undermines that confidence. So I don't laugh anymore. Now I want to add into that some remarks that will really make you happy about international instability. Because I was doing this, I worked for Chapman Law School, and I have for 20 years. And so I have a 401k that's 21 years old at Chapman. And I, of course, had not looked at the asset allocation in about 10 years because I'm the average Joe. How many of you have looked at your asset allocation in the last 5 years? Okay, but some of you might not be clients, right? You're a client. Okay, you see, that's the 401k is beyond the smart guys. It's Fidelity. It's run by, I don't have any options. It's run by Chapman. There are no smart guys. You have to make your choice from among 20 accounts that Chapman has. And so I went and I looked at it because I had not looked at it. And I had 17% of my assets in a European bond fund. Now, I had no idea that that was the case. And so I asked Brian Westbury on the air yesterday. I said, Brian, I looked at my asset allocation of my 401k, and it's got 17% in European bonds. And he went, which is really not what you want anybody to say about your asset. So I'll change that on Monday. He said, that's really, and then he went on to say why the European stock market is undervalued, which was kind of interesting. There's this stuff that these guys do and I don't do. He said, oh, no, Siemens has got more people employed outside the country than inside the country. If you want to move that into, I said, I was kind of funny. I said, Brian, let's talk about the most important thing, me. And then we talked a little bit about asset allocation. It was a way of setting up, getting ready for this, and I'd been doing that. But it's remarkable to me. Then we talked about Europe. Europe is a mess. I shouldn't have any European bonds, and so I won't next week. Right? It's an utter, complete mess because Russia has all of their energy, and Russia is run by a madman. Not a madman, but a power-hungry czar. He's not a communist. He's just an authoritarian, power-hungry czar. And he wants, whatever he wants, it doesn't make a lot of sense. Nobody should want Eastern Ukraine. There's nothing in Eastern Ukraine to want other than the former glory of the Russian Republic. But he's doing irrational things, and he's dispatched troops and tanks, and they're running overflights. Sean can tell you this. They're running their bombers and their strategic weaponry into the Gulf of Mexico, and they're doing things up in Alaska. It's just bizarre, weird stuff that ought not to be happening in the post-Soviet era. If you look at China, China is doing a series of very odd things. They're provoking confrontations not just with Japan over a string of uninhabited islands, but also with Vietnam, where they have established an oil drilling platform in Vietnamese waters, and with the Philippines. They are, in essence, attempting to implement control or authority over the South China Sea in totality so that they can decide who transits it. It's it would be like ours saying, we run the Great Lakes with Canada. Only we share it with Canada. And no one doubts that we run the Great Lakes with Canada. If you're going to go through the Great Lakes, you're going to have either American or Canadian permission, and usually both. The Gulf of Mexico is an American lake with some participation of Mexico in its governance. This is what we do. And off the coast of Florida, we have China wants the whole South China Sea, which is much broader than even an expansive offshore thing. They're claiming island chains in order to establish a perimeter. And there is within China an insurgent group of military thinkers called the Tigers. Henry Kissinger writes about them in a book called On China, which I recommend strongly to you, that suggests an outward aggressiveness driven by an inward calamity. The inward calamity is demographic. The inward calamity is they have too many people and too few resources and not enough jobs. They're going to stimulate their economy. They're shipping people overseas. They have demographic issues. It's a tremendously unstable regime. If you read on China, you realize that when China becomes unstable in the past, they typically respond with short, sharp wars. People say, what do you mean? They invaded Vietnam in the late 70s. They invaded India. They took over Tibet. Ever since Mao came to power, every few years, China engages in a short, sharp war that is designed to both stoke nationalism, submerge domestic international problems, and achieve long-term goals. People are thinking that Quemoy Matsu, Taiwan, that the smaller island presents that sort of opportunity, but there's the Philippines, the Japan, et cetera. We could leave the room and have an international crisis. Korea is run by someone who is absolutely bonkers. And in being bonkers presents a danger of regime collapse. I mean, he shoots his uncle. I've got a few uncles I'd like to shoot, but I mean, that's figuratively. Normally after Thanksgiving dinner, right? That's when you... I'll be doing my annual Wednesday show on how to get the party started at Thanksgiving. Usually involves a, isn't Sarah Palin great question at the beginning. It really gets it going, but I have a few other ones. I think the first one's going to be, I think the president should have gotten further on Thursday night. That'll get the ball going and break the China early. But so North Korea, and then worst of all, for those who follow this stuff, and Sean, did you serve in the Middle East? You fly in the Middle East? No, the Med. Okay, but you're in the Med. The guys who are flying off of our carriers and dropping bombs in Syria and Iraq and other places are in very dangerous circumstances. And the people who are insurgent there are out of their minds fanatics. They're not crazy, but they are fanatical beyond any measurement. And I spent some time with an agency analyst this week, and I won't say which agency, you can guess. And the agency analyst spends all of his time on jihadi websites. And jihadi websites are scary. There's a split between al-Nusra and ISIL, or ISIS. The president calls it ISIL because the president has got this arrogant word. He just can't do it. Pakistan, ISIL, to whatever it's in his head. I'll be different. But they have a deep division over strategy. Al-Nusra, which is al-Qaeda's affiliate in Syria, does not believe in unnecessarily antagonizing non-combatants. ISIS believes in killing them. And so there is a deep division, and they hate Baghdadi and the al-Nusra guy hate each other, but they even came to a truce this week. And we're pinpricking them. We're doing selective bombs. We almost knocked off Baghdadi last week. We got his deputy. We're doing some damage, but we don't have boots on the ground. And I had Tony Zinni on this week. How many of you are Marines? Any Marines here? Well, Tony Zinni was the Marine who ran Central Command right before Tommy Franks. And Zinni is no friend of George W. Bush, hates Rumsfeld, wrote this damning book. But he believes we need boots on the ground because this is a metastasizing cancer, that this is an absolutely out-of-control group of non-state actors without any regard for vulnerabilities. They don't act rationally with regards to how other people might respond, but they've judged our president correctly, right? And they are not that far from the Saudi oil fields. This is what, and they're not that far from Jordan. And so there is this wild army of fanatics with a lot of equipment who are not far from international oil fields, which adds a level of complexity to the analysis you're going to get here. And I'm only half done. I haven't done the domestic problem yet. And I want to add the last part of this, which is, well, two parts. Nobody ever talks about Brazil, but South America is teetering on the edge of crazy stuff too. You couldn't get me to go to the Rio Olympics. Honest to goodness, I was in Rio on a cruise in December. And I loved Rio, and I loved Argentina, and you couldn't get me to go to those games because nothing works in that country. And I don't know how you're going to get to any event. I don't know how they pulled off the World Cup, except that it was all over the country, not in one city, and it was just soccer fans, and they walk. Most Americans don't walk anywhere, and they expect to be picked up by Uber and taken to their hotel and then taken to their venue, and that's the Japanese Olympics. You want to go to an Olympics? Go to Tokyo in 2020. That place is amazing. Put up your hand for 1 second. Cab there, nicest people in the world. It will run boom, ba boom, ba boom. Brazil, no thank you. But their economy's in a mess. Put that aside. In the Middle East, on Monday, there will be announced a deal with Iran because this president will do anything to get a deal with Iran. That deal will allow Iran to retain the ability to enrich uranium. That is unacceptable to the Israelis. It ought to be unacceptable to us. The new Congress will get a few weeks to pass the rejection of that and reimpose sanctions. And if they don't, I fully expect Israel to do what it has to do to remove that capacity. So I believe that there will be a major confrontation in 2015 with Iran if the president vetoes and we don't override the sanctions were working. This guy is such a bozo. They were working. They had been brought to their knees. Their economy was shattered. They were going to give up. Khamenei had internal growing pressures. The Iranian Revolutionary Guard had splits. You remember the mad mayor who became the mad president, not Rafsanjani, but Ahmadinejad. They were split. They're all split all over the place because the sanctions were driving everything into the ground. The president has lifted the sanctions, and he's going to leave them lifted. We have to put them back on, or Israel will have to act. So I'm just saying 2015 internationally, I used to worry about the Soviet Union a lot when I was 30 and 25. That's what I grew up on. That's what I studied in college. That's what Nixon and I wrote books about, were the Soviet Union and the Russian threat. I kind of long for the days when there was one enemy and you could count what they had and you knew what you had to build. Meanwhile, historically, the United States has built devoted 5% of its GDP to national defense. We are now spending 3.4%. We have barely 282 ships. Most of those are not at sea at any given time. We've hollowed out the Army. The Marine Corps is down to 180,000. Everything has fallen apart because this president has spent all the money on stuff that's all gone. I mean, I don't know how you spend $800 billion and you can't point to anything. Ask your Democrat friends that, by the way. Where did that $800 billion go? Because it's hard to spend $800 billion. It's not entitlement money. It was shovel ready. Where is it? I grew up in a town with a high school that was built with Works Progress Administration money in the 30s, with a pool that I lifeguarded at that was built with Works Progress Administration money in the 1930s. All over this country you can find WPA buildings that were built with Works Product Administration money in the 30s and the 40s. FDR's program. They really did do shovel ready. There's nothing, 800 million. Imagine if we had given the 800 largest cities in the United States $1 billion each as an endowment. And we said, you may use 10% to build a medical facility, but the rest has got to be an endowment to run it for the poor. We would have 800 charity hospitals operating, fully endowed with $900 million, which is a lot of endowment to serve the poor. That's how I would have done a stimulus. You would have had 800 clinics, 800 construction projects, thousands of doctors, lots of free care, would have worked. That's way too easy for the Democrats. They had to spend it in a way that it's impossible to find where it went. But I digress. So we have international instability, and we have in these Republicans. Now here's the good news. Mitch McConnell is really smart. I know some of you were, and I know the man who ran against him in the primary now. I've gotten to know him. He's a good man. I look forward to supporting him in the future, but I am a big Mitch McConnell fan. In the last week of the election, I went to Louisville twice, once to appear at Southern Baptist Theological Seminary and once to appear with Senator McConnell, Bobby Jindal, and Carly Fiorina at a rally for Mitch. And everyone was wrong. We thought it was close, and he won by 15 points. We thought Tom Cotton was close. He won by 17 points. We thought it was close in Kansas, and Pat Roberts won by 10 points. And I mean, the country was significantly to the right of where the pollsters and the media thought it was. And I think it's moving that way. I think they're very disgusted with Obama. And I think Hillary Clinton created a tremendous mistake on Thursday night when, within 10 minutes of the president completing his remarks, she tweeted out an endorsement of his action. Because I think, I'm for regularization. I'm kind of a wet on immigration, but I'm not for lawlessness. And I think a lot of America is very upset with this at a very profound and deep level. They're very upset with Dr. Gruber telling us we're all stupid. And we just found the IRS emails that were allegedly lost, 30,000 emails. 30,000 emails. Who knows what's in those 30,000 emails? How many of you would like, put your hand up if you would like your last 30,000 emails in the public domain? I can't even imagine what that's going to be like. So they've got some political problems, but we have smart leadership. Here's the trouble. I feel very good about the world and the economy in 2 years. In like 2017 and 2018, I felt this way because I thought we were going to elect Romney too, so I'm being an optimist. You have to factor that. But I think we're in for a wild ride for 2 years. Because what's going to happen, they're going to come back and they're going to have a few things set up. Nothing's going to happen in the next 2 years, by the way. Nothing significant. There'll be a few. We might be able to reimpose the sanctions and repudiate the Iran deal. That might be veto-proof. The president's going to veto everything. He's not going to sign. He's not interested in compromise. Nobody trusts him. He is the lamest of ducks. How many of you have a grandchild under the age of 6? How many of you realize how fast the last 2 years went by in their age? Boom, really? 2 years? He's done. He is going to be gone before you know it. 2 years in this country is like a blink of an eye. It really is. But it's going to be every day. David Mamet once told me about raising children that the years fly by and the afternoons are endless. And so, right, you all know that. So the years are going to fly by. He's going to be ex-President Obama before we know it. But those 2 years, every single day is going to be like the worst landing that you've had in a bad airplane ride. And I can remember that. It was Hilton Head Island in 1986, and we landed in a thunderstorm, and I did not think we were going to get down. And I was very upset because Madeleine Albright was in the aisle in front of me, and I knew if the plane crashed, no one would know I was on it. Madeleine Albright was going down in that plane. That would have been, everybody else would have been an afterthought. So that's what we're in for. And I don't know, and I do not purport to know, nor did I stay at a Holiday Inn last night, what Bill and the rest of the Money Guys team is going to recommend to you about asset allocation. But it's going to be very bumpy because we're not going to pass anything. But we're going to get to a place that's going to be very good. We are going to reform the tax code in 3 or 4 years. And that's a 3 or 4 year process. And that reform is going to have some tricks to it. And I don't know what they're going to do with the home mortgage deduction, the charitable deduction, and the state income tax deduction. Those are the big 3. That's where the money is that Paul Ryan needs to get rid of if he wants to lower the marginal rate. We are probably going to get rid of the alternative minimum tax, which will impact a lot of people in this room, and the eclipse of which will create, I mean, these guys are going to be working. Bill, you never intended to retire, did you? No, sir. You can't, actually. I don't think you can retire in the next 5 years, 10 years. And then, on top of that, the Financial Regulatory Administration has made it so difficult to lend money that startups of new businesses are becoming increasingly difficult to anticipate, and inversion of corporate ownership is proceeding at such an incredible pace. I don't really know how to value stocks. I own one individual stock, Apple. I own Apple because I like its products. And I like to look at one stock. Otherwise, I just don't own stocks. I like Apple. I like to look at one stock. And they've got all their money parked. So I know this. They got like billions of dollars parked outside of the United States. They won't repatriate the money. So they can't use it in the theoretically most efficient way possible. So that if you can't, I don't know if they would bring it back, but that they can't bring it back tells me they can't make the maximum efficient. It makes me crazy. And that is the case with every American company. They can't operate in the maximum efficient way possible. So let me flash forward to the politics, and then I'll turn it over because I want to take a couple of questions. I want to be done at 10. I have to drive up to L.A. and pick up my son who's coming in for Thanksgiving. He works for a political outfit back in D.C., and I think he's still happy. It's been a week. They're 2 weeks, and they're still happy. And he's not involved with the Cassidy campaign, so thank God he gets some time off. We've got an abundance of great candidates. I was a big Romney guy until fairly recently. I thought Romney was going to run again, but I always thought he was going to run if Jeb Bush or Rob Portman didn't run, and now I think they're both going to run. And they are very Romney-esque. They're very center-right establishmentarian candidates who will be reassuring to big business in Wall Street and Main Street, and they'll attract enough money. So I don't now see the governor getting in. If you saw Jeb Bush change his mind and not get in, I think you'd see Governor Romney flirt with it. At this point, I believe Ted Cruz is the overwhelmingly likely nominee of the party. Ted's a friend, and I've told him I think right now he's going to lose 45 states. And I'm going to host a dinner for him in December in L.A., where I can introduce him to my friends to raise money, because I want him to tell me how he's going to win. I don't know how he's going to win. I'd love him to be president. He's just brilliant. And you don't win 9 Supreme Court arguments because you're lucky. But I don't know how he's going to win, so I'm going to ask him that and find out. We've got Marco Rubio, Rob Portman, Rand Paul. Lindsey Graham's going to run. And he's going to run in order to block anybody marching to the nomination very quickly in South Carolina. And by the way, this campaign is underway already, and the first debates will be in September. And that's important. We got to nominate a winner against Hillary, right? We're going to run against Hillary. Everybody knows that. I think she's got a glass jaw. I can't be sure about that. She's going to have more money than God. We ought to be carpet bombing her right now, the way that they carpet bombed Romney. I left the White House with no money. Really? You left the White House with no money? I don't know where I was on Benghazi. What difference does it make? I'd be playing that again and again. You're in favor of the executive amnesty, which is unconstitutional. I would just brand Mrs. Clinton as a failure at the Department of State, which she was, as the grandmother of Obamacare, which she is, as slippery in her public persona, which is as long as her husband. I mean, we're really running for Bill Clinton's third term, right? People are really voting to reelect Bill because they want the fun back, but I think we have this advantage. Most of us in this room are over the age of 50. We don't think of her as old. Everybody else does. I mean, anyone under the age of 50 looks at the Clintons and they say, my God, those people are like watching reruns of Seinfeld. They have been there forever. And the reruns of Seinfeld are interesting, but they're not exciting. I asked this of Josh Krosher, of the political editor of the National Journal yesterday. Does anyone get excited about Hillary Clinton? Anyone? And the answer is no. Nobody does. So I think we can win if we nominate someone who's good. Now, we've got Christie and Walker and Perry and Jindal and Mike Pence and John Kasich. We've got a half dozen governors. We've got interesting people like Ben Carson and Peter King and Mike Huckabee, who are kind of movement conservative, interesting people, or national. And we got all these senators. We got Paul Ryan. It's going to be a roller derby, right? A roller derby, an absolute car crash. What do they call those when they brought all of the cars together? A demolition derby. And how that is managed prior to the Republican convention in Cleveland will matter. And, we have the calendar set in February, 14 months from now. We will have Iowa, followed by New Hampshire, followed by Nevada, followed by South Carolina.
Then we will take 10 days off, and March 1st is the first day that all of the primaries can be held. Anyone can have a primary they want, but that primary's got to award its delegates proportionately. And on March 15th, anyone can hold a primary they want, and those delegates can be awarded winner take all. So we'll have a nominee by March 15th. Seems almost, or we'll have a brokered convention, which would be a lot of fun in my business, right? That would be, and it's in Cleveland, home of the super champion world Browns. Cavs had a bad night last night. A little trouble playing with three superstars. Josh Gordon is back this weekend. They're 6-4. Browns are going all the way. So we're going to have. That's why you don't take economic advice from me either. So we're gonna bring Bill up and his team to talk about this instability, but it's just going to be the craziest 2 years, and I don't know how you do that. But before I do, any questions or comments before I depart for the back here? The question is, what's going to happen with the Keystone? It will come back to the president in the second week of January or the first week in January. The new Congress will pass it overwhelmingly in the House. It will get 60 votes in the Senate, I believe, and it will go over to the president's desk and he will veto it. And there will not be enough votes to override the veto. So it won't get voted on, but it will get 60 because of Heidi Heitkamp in North Dakota, Joe Manchin, and a few others. So we got 54 votes for it. We need to pick up 6 Democrats. I think there'll be 6 Democrats who see in support for it the reality, but not 13. So we're not going to get it until we elect a Republican president, and that's good. Well, we don't, I'd rather have the oil now, but I also like the political issue that will define the Democratic Party as anti-energy freedom, which is also pro-empowerment of the Islamists. Yes, sir. It's going to be, this is what I do. I'm a regulatory lawyer, and I have already told everybody, I have no idea what they're going to put out there. I think they'll blow off notice and comment. In the technical term of the Administrative Procedure Act, you have to put out a proposal for 90 days of comment. Then you're supposed to take that back in and review it and then put out the final rule. And then the final rule is always challengeable in the D.C. Circuit Court of Appeals. The president packed the D.C. Circuit Court of Appeals. So that's the circuit on which I clerked. And so you could always count if they did a wild rule, just something crazy, you go to the D.C. Circuit, and the D.C. Circuit for the last 25 years has said that rule's no good. The president packed it. It's now 7 Democrat judges and 4 Republican judges. So we can't count on any systematic review of the rules, and the Supreme Court can't take all those rules. So we are in for a regulatory environment that is, I mentioned earlier, Bill and Tom and Marcelo and Sean, they have to worry about that because energy stocks will be among the most deeply impacted. If you're in the energy business, the EPA hates you and they want to shut you down. And if you are in the land development business, the U.S. Fish and Wildlife Service hates you and they want to shut you down. And there used to be ways to stop that. And there are still some tricks left up my bag, but I'm pretty much out of tricks because I could always sue them. And now I can't. Now if I threaten to go to the agencies just laugh because unless you're in we're in the Ninth Circuit, which is the worst circuit. If you're in the 8th Circuit or the 7th Circuit or the 5th Circuit, and sometimes the 6th Circuit, you can get judicial relief. The rest of the country is run by Obama judges and Clinton judges, majorities of them. And so it's really become 2 judicial systems as well. We're living in the wrong circuit, right? If you were going to buy property, you'd buy property in Ohio, Michigan, Kentucky, and Tennessee, maybe in Utah and Colorado, maybe a couple other places, but you would not out here. There's no guarantee you'll get to use it at all. One more. Yes, in the way back. I am adamant that we not talk about the I word, and I cut callers off because I think they're Democratic seminar callers. After all these years, Democrats will call you up and they'll say, I haven't been a Republican my whole life, and I think we ought to impeach the president. Well, they're not Republicans. I don't know any Republicans other than people who write on the web, very strange websites with very few followers, want to impeach the president. It's like the worst idea ever. It doesn't work. It's a hand grenade that you fall on that you didn't have to pull the pin on, right? We don't want to do that. Repealing Obamacare is less crazy in that it will, I actually thought that the government shutdown last year effectively branded us in advance. I'm not sure it was a knowing strategy, but it effectively branded us as having nothing to do with the website rollout fiasco. And so we won a big, overwhelming victory. So whatever the shutdown did 2 years ago or a year and a half ago, it didn't hurt us at the polls. It helped us at the polls. I wouldn't shut down the government now, though. And we're not going to repeal Obamacare because we haven't got 67 votes. We can pass it out of the House. We can make Democrats take votes on it now, which Harry Reid never made them take votes on it. That's the advantage of a 2-year, it's like a football game. We are now in the fourth quarter of the Obama years, and we finally get to score some points. And we're going to score a lot of points. I don't know if we can catch up in time for 2016, but we're going to score a lot of points by making them take votes that will demonstrate who they really are. They can't avoid that now, and that's good. Clarity is, as my friend Dennis Prager, and he is my friend most days, clarity over agreement. And so I want clarity on who would repeal Obamacare and who wouldn't. Some Republicans are purists, and they used to have a control on the caucus. They don't have a control on the caucus anymore. There are not enough. When you get to 247, John Boehner can look at the dozen or so who are purists, who won't vote for a budget that doesn't immediately balance, and say, okay, guys, fine. You don't matter. I can still pass it. The magic number is 218. So he's got 30 votes to play with. He can lose 30 Republicans on any given vote. So if you can't carry the caucus with a 30-vote margin, you're not much of a leader. So it's let the good times roll. And good luck in getting good advice from these guys today. It is my genuine pleasure to be associated with them. Bill, I turn it back over to you, and I head to L.A. Be well, friend.
Now, we get to try to take all that stuff that Hugh has mentioned and bring it into what do we see the impact on the economy, some global, some domestic, and then from there we're going to talk about, with that information, what do we do going forward on the investment side. So it's a great pleasure. Sean Walker. Sean is applause for Sean. Thank you. Those of you that were at our halftime report met Sean, and you know that he was a Top Gun pilot. But he was very, very gracious in describing it that he was not Tom Cruise, he was Gooch. So, brilliant guy. Came to us, background in mergers and acquisitions, Wharton School, MBA. He's just got more knowledge. He's forgotten more than I ever knew. So it's going to be brilliant on what he's going to do with the economy. And then we'll go to Tom, and then I get to wrap it up. So with that, we'll turn it over to our buddy Sean.
All right, thank you. Can everybody hear me? Yes, thumbs up in the back. Hey, great. Well, it's a pleasure to be here with you today, and as the newest guy, I guess I drew the short straw in that I'm the one who gets to not only follow Hugh, but I get to brief you on a scintillating Saturday morning economics lesson. So, I'll try to keep it quick. We'll go over as tops of the trees as we can, but it is all about the economy. Now, we remember this line from James Carville, and I don't know whether Democratic strategists have an affinity with the word stupid as of late, but it truly is all about the economy, and I think the electorate really spoke that in very hard-to-miss detail in the past, over the past election. So with that, just a few ground rules. For starters, economists have a tendency to get into wonky stuff. We don't want to digress into irrelevance, and my promise to you is I won't do that. If I do, if you have anything on the table and you want to throw it at me, that's fine. I had to avoid flying objects before. But this is going to be a wonk-free zone. We'll stay away from it. We'll keep it tops of the trees. But what we want to do is we want to take a look at the year's events in perspective. So let's recap some of the larger stories of the year, and we'll fold that back into the rest of the story. Now, the first thing that comes to mind is this last winter we had this big bout with global warming that brought everything to a standstill. As a matter of fact, we lost 2% off of our GDP thanks to 6 feet of global warming across the Northeast. Next up, right after the Sochi Olympics, we had the Ukraine crisis, as Hugh very eloquently put out, that wasn't necessarily a U.S. economic issue as much as it was a European economic issue. But the one thing that it did show in broad detail was the lack of American leadership in this world. We were losing political capital. That was followed shortly after ISIS going on the offensive, where we are now seeing that we may have to dedicate additional treasure, our treasure, whether it is in gold or in blood, back to this region. Israel had their conflict with Hamas in Gaza, where they really restored, or not restored, but exhibited their resolve in protecting their own sovereignty when they were being just bombed mercilessly by Hamas. So what we can take away from that is, again, it's not necessarily a U.S. economic issue, but it will come into play shortly. Israel will not be forgotten, and whether they do so in a unilateral manner or not, they're going to have something to say about a nuclear Iran. Ebola outbreak is, again, it was more of a flash in the pan, but it was recent enough where it spoke to specifically American leadership, or maybe the lack thereof. We were coming from behind yet again, and that was recent enough where it ushered in the latest shift in power in Congress. Now, what can we expect going forward? Well, we have already got our immigration thing that we've got to deal with. There are other issues like Keystone that are coming down the pipe. But again, the stage is kind of set where we are today. So with this perspective in mind, let's take a look at kind of the larger view. We have equity markets that are really performing quite well. We have a fixed income market, or bonds, that are essentially stagnant. Quantitative easing is going to be coming to an end. The Fed is, I think we can see the last of this by the end of this year. The U.S. economy is growing, not booming, growing. It's been a very, very lackluster recovery, but it's not been the steepest of hills upward, but there are signs that we are recovering very well. And international markets are uncertain. Not necessarily that we expect Mercedes-Benz to go under, but from a monetary perspective. And Tom's going to get into that, so I won't tread on that too much right now. All right, so let's dive in with the domestic markets. Now, if we all played Rip Van Winkle and we put $10,000 into our accounts, just let it sit there on January 1st, went to sleep, we'd all wake up and boom, as of today, hey, wow, that's okay. Compared to last year, it's not as good, but today I was at I'm at about 11.5%, 12% on the S&P, maybe about 6.5%, 7% on the Dow. That's not too bad, I guess. But the thing is, you would be asleep for all of this other stuff. You'd be asleep for all the volatility that we had. We had a couple drops, and there was a lot of movement. So how many people, just by show of hands, how many people have seen Marathon Man? Anybody? Dustin Hoffman, Sir Laurence Olivier? What was he asking? Sir Laurence Olivier was always asking, is it safe? Is it safe? Well, that's the question, isn't it? We've got good performance, we've got a lot of volatility, but is it safe? So let's take a look. What we see in this slide, and I hope you all can see it, we've got earnings per share for the S&P 500 since the downturn, and we've got the S&P itself going up. Now, the good news is that both are going up. Now, the scales are a little different. What you won't notice is that the earnings are not going up as fast as the actual price of the S&P 500. It's a little bit expensive, not overly so by historical terms, but it's just a little bit expensive. And even though earnings are going up, we like to concentrate on the quality of those earnings. And anybody here who has to run their own budget around their own kitchen table, there are two ways to end, or a combination of ways to end up with more money at the end of the week. That's either you forego the trip to the movies, you buy the generic cornflakes instead of the brand, and you control your costs. The other way is to actually get a raise. Get some more money through the door, and maybe I can live a little more lavishly. Okay, or maybe there's a combination of the two. The same thing applies around the boardroom table as it does your kitchen table. What we want to see is we want to see a good combination of revenue growth, because that's how you sustain growth, as well as earning growth. So with that, let's take a look. This is a nice fancy chart that was put together by the folks at LPL. And if you can get through all the busyness, you'll see that, yes, earnings growth has gone up in this line right here. Earnings growth has gone up by 10%. And this is with earnings season. All the public companies, they come in and they report. And over 74% of the S&P 500 that reported, they beat estimates, which means earnings are on the rise. Well, that's good, but let's take a look back at the quality. The quality demonstrates that there is good revenue growth as well. We had about 60% of these companies also beat revenue expectations. So that's good, right? We've got revenue growing, we've got earnings growing, things are going okay. So you ask yourself, why are we going through all this chop? Well, the first thing I would say is that it's just part of the deal. That's why we diversify. That's why we think of a diversified portfolio. That's why we have some market, we have some fixed income, we have some alternatives. That's what we recommend to you, that's what we talk to you about. But specifically, it's all part and parcel of a recovery and a bull market. And this is just another step in the road. And despite the fact that we had ISIS, we had Ebola, we had the Ukraine and everything else, this past October, we had a 7% case of whiplash. The market just plummeted. What else did we have in October? Elections, precisely. And this chart right here shows the VIX. Now, to the uninitiated, I'll get wonky, I'll break my promise. The VIX is an index that was created by the Chicago Board Options of Exchange that measures the volatility on the underlying options of the assets of the S&P 500, blah, blah. I sound like the father from Charlie Brown, right? For those of us that only speak English in here, basically all you need to know about the VIX is it measures anxiety, uncertainty. And what this chart shows is that in the months, typically September, October, November timeframes, in those months surrounding an election, the VIX shows about 15% more volatility than it does in those months without an election. So maybe that had a little something to do with it. But there's a good side. And what is that good side? The good side is that since 1950, we had what? 16 midterm elections? 14 of those 16 midterm elections, the market did well. As a matter of fact, it grew by over 5% in that single quarter. So there is bumpiness, there is change, but 14 times out of 16, there's been pretty strong growth. You compare it to the rest of the time periods without the election, you'll see, I mean, the difference is pretty significant, statistically significant. All right, so with that, yes, we still believe in the market. We still believe in equity. We still believe that it has a way to go. It's getting a little bit more expensive, but it still deserves, specifically domestic equity, it still deserves a very significant portion of your asset allocation. So when we're going into these markets, we really pay attention to people who are stock pickers, who understand their holdings, who have conviction over their holdings. It's not just some formulaic job, but it's an idea where they know their companies. They don't have a million holdings. It's not an index. It's not an ETF. So those are the things we look for as we're entering this market. So with that, let's move on to fixed income for a second. Now, what is fixed income? Fixed income is the bond market. It's basically you taking your money, lending it to somebody else. Why do we like that? Well, we like it because we have this little coupon book. We clip a coupon, hand it back to the person who borrowed the money, and they write us a check. Typically, that check doesn't change, and that is a dynamic that we like. Now, before we go much further, just a basics of economic lesson as it pertains to the bond market. The things that you need to know is if interest rates and yield go up, the prices of the bond go down. And conversely, if yields go down and interest rates go down, the prices of the bond go up. A+. Good job. So with that, the overview is essentially a ho-hum overview. 3.5%, 4% is what the Barclays Ag Index has produced in the past 12 months. Now, that's not something that comes totally unexpectedly because we've had interest rates pushed down artificially for many years. And with that, that means the bond prices are pretty high. Does that mean that it doesn't deserve a place in your portfolio? Well, that depends on what stage of life you're at. But typically, we're not big fans of bonds right now. And what's happened? Why is this happening? There's been changes. These three, F, G, and H, and you probably can't see the actual numbers, but here's what happens to the yield. Remember what I said, when yield and interest rates go down, prices go up. When prices go up, yields go down. And the reason why in these areas yields have gone down is because people were terrified about Europe. And when people were terrified about Europe, where do they come? They come to the U.S. There's a flight for quality, and they come to the U.S. and they buy. And when there's a lot of buying going on, that drives prices up, yields go down. But Sean, what about this time frame? Yields went really high here. Well, that's what happened when Bernanke came in, and we called it the taper tantrum. He didn't even say quantitative easing was coming to an end. He said, we're thinking about considering the potential change of quantitative easing. And that sent everyone scurrying for the door. Huge sell-off, yield spiked. All that said, where have we historically gone when we've looked for some glimpse of positivity, some glimpse of yield? Well, we go to the high yield market. Now, if we go to the high yield market, even then, there's nothing. Not really nothing, but it's just we're not getting paid historically for the risk that we're taking. It's like going to someone with a 500 credit score. It's a really over-the-top analogy, and lending them money for 3%. Would you do that? No, you wouldn't. So that makes us really reconsider where we're going to find income. And Tom and Bill are going to get into that. But that said, I mean, this is a good segue into interest rates. What's happening now? What's happening with the economy? Who's controlling it? Well, it's the Fed. And for time and continuum, the Fed has been unpredictable. Pundits have tried since Volcker, over to Greenspan, Bernanke, and now Yellen. Nobody can really predict which way the Fed is going. But after careful, robust, exhaustive trend analysis, I think the one thing that we can walk away with, and I think we've met on this collectively, that the next Fed chairman, based on our trend analysis, will most likely be Mini-Me. Deep, profound thought went into that analysis. But beyond that, but as we're thinking about what the Fed is going to do, we have to remember what their mandate is. Now, you could sit there and read what the Fed has put out as far as what their mandate is, makes for really a nice plaque on the wall. But really what you need to take away from it is that they have two mandates. And what are those two mandates? Keep inflation in check and keep unemployment in check. Now, inflation is a tough one. We all want growth. We all want the economy to grow, grow, grow. But what is the medical condition of uncontrolled growth? Cancer. Precisely. That's not something you want. You want it controlled, you want it contained. So let's take a look at where we're at as far as the measurement of the CPI. Historically, boom, it's in check. We're looking good. So reasonable person theory states, well, let's stay the course. What about unemployment? Unemployment, this is going to be a loaded graph for a lot of people in this room because we're high information voters typically. We know that that number there doesn't take into account people who just got out of the workforce. We take into account the fact that that encompasses people working multiple part-time jobs for economic reasons. They've got to work there. But the one undeniable fact in there is it is going down. It is. Now, we can all sit here and postulate how much faster this economy would be growing and how much less employment there would be if the government didn't have its boot on the throat of companies in the way of regulation, because I've talked to a ton of small mom and pop businesses. And that 51st employee that they have to hire is the most expensive employee that they will ever get. It is truly a governor of American small business. But we'll have that discussion over coffee. All that said, okay, so the Fed is thinking we have inflation checked, we have the trend going down as far as unemployment. So we just stay the course, but we still have to think ahead of the game. The economy is a slow-moving ship, and you have to think miles ahead of it. So what else do they look at? Well, they look at GDP. And again, the trend is good. And aside from this bout with the global warming here, things are going pretty well. It looks positive. Even as you take a look at deficit spending. Deficit spending is now a fraction of our GDP compared to what it was during the depths of the recession. What else does this country do real well? It's a construction-based economy. We like building things, specifically homes. We've seen a recovery in the prices. It's been kind of a staged recovery. There's a dip, there are short sales, there are foreclosures, and then we rise back up again. But there is good news. We have seen a small sustained rise. But the other good news is, and this is good news, it's not great news, it's not awesome news, but it is good news in the fact that not only do we see an increase in existing home sales, but that means we also see an increase in new home sales. That suggests that we're really working through that inventory of homes, existing homes that were on the books, and combined with rising prices, that points to growth. Again, these are all things that the Fed is taking into account. So, okay, we've got growth here, we've got growth there, unemployment's going down. What else? Do we take a look at the financial stress of the markets? Now, how do you do that? How do you take a look at measurable, typically measurable items and relating them to an intangible theory of financial stress? Well, the Fed did it. Actually, 3 Fed banks do it. And you can see, arbitrary as it may seem, the graph speaks to you. During the height of the recession, there was a ton of financial stress. Now, it's dipped considerably, but there's still an upward trend. So let's wrap this all together. Where do we think the Fed is going in the next couple of cycles, the next couple of quarters? Well, we have this growth. Most likely they'll want to stay ahead of the growth to cap it a little bit, just to make sure we don't run into an inflationary environment. We think that anywhere between mid-2015 and late 2015, we should see most likely a quarter-point bump up in the interest rates. The market kind of agrees with that assessment. They feel by the end of 2015 that that's been priced in. The yellow dots are the Fed officers, and these are the surveys that they took. This is not unusual, by the way. The majority of the Fed officers kind of are above that line. Doesn't always mean that it's going to get there, but the market is priced in basically a quarter point, and I think we tend to agree. Maybe going out to another point maybe a quarter point every quarter going out. So let's wrap this all back into where we see the economy going based on the election results. What things would be great for this economy? First of all, tax reform. Yes, tax reform would be great. Now, I mean, there's the tax reform, there's the kitchen table conversations, but then there's the broader boardroom table conversations. When Hugh was talking about the billions of dollars that Apple has overseas, that's just Apple. There's over $2 trillion, dead presidents, that are sitting in the banks overseas of money that could be repatriated. Further, what could we do if we made some change to the tax code where you didn't have Burger King trying to buy, was it Tom Hortons? Tim Hortons, thank you. I need my cruller, eh? Tim Hortons donuts just to get to Canada so they can pay lower taxes. That's not unpatriotic, that's business smarts. And if we were smarter, we'd have people coming in here, and that would be great for the economy. What about regulation? Well, we talked about regulation. We talked about that 51st employee. But there are other things. Obamacare is going to take hold. All of the small businesses are feeling that right now. We have OSHA requirements. We have EPA requirements that we're worried about. We have the energy issues that we need to discuss. There are other things that Hugh, I wished I had a chance to ask Hugh this question. We have this budgeting process where we pass this huge omnibus budget. And it's either a take it or leave it. This new Congress coming in would probably rather make just targeted budget funding bills that they want to send to the president. Now, if they did that, that would benefit a whole lot of industry, namely, number one, defense. Because after all, who would want to have a robust defense in a current ISIS world and China and Russia acting as they are? I'd like to have that. So you can look for sectors, specifically companies like Northrop, Raytheon, Lockheed, that are very, very defense-centric to improve. So with all those things, we're still very bullish about the economy. We're still very bullish about our stock market. Tom's going to come up here and he's going to tell you a little bit about where we want to tactically employ our investments for the portfolios over the next 6 to 12 months. Thank you for your patience, everyone. I hope it wasn't too painful, and look forward to fielding questions after this is all done. Thank you.
Good morning. Everyone doing well? All right. Let's carry on. So it's been said that the biggest impact on your long-term return is actually through asset allocation. There's been studies that go all the way back 20, 25 years that say that asset allocation is the single largest contributor to actually what happens in your portfolio and how your wealth is created over time. So that's why asset allocation is such an important part of the discussion today. And I've had the pleasure over the last 5 years of really having that discussion with you and talking a little bit about that. So today is going to be another part of that whole thing. Now, so many times you see on your statements the pie chart, right? The pie chart is kind of omnipresent, and you see all these colors, and they have all these different acronyms, ST, LT, BND. They put all these things on there, INT, EQ, like international equity. You're trying to decipher what all that is. Our firm, at least 4 times a week, meets inside our conference room. It's well used. All those chairs are well conformed to our sizes. And we sit there and hack out what we want to do with asset allocation, how it's going to impact your portfolio, and interview all the best companies. We had in this week, we had Goldman Sachs in there, we had Fidelity in there, we had Vanguard in the last week. We've had, the biggest financial companies come into our office. All the money guys sit at the table, and we sit there for an hour to an hour and a half every single time they come in and hammer these guys. What's happening in the markets? What's happening in politics? What's happening in your portfolios? What are we supposed to be looking at? Getting information. They brought in a senior portfolio strategist from Goldman Sachs, who was a brilliant lady who came in. We were able to get some great insights about future interest rate stuff. We're able to take that. After they leave, we sit around, we assimilate all that information, and then actually make decisions in your portfolios and in your personal cases as we think about the best way to execute it. So this is a big deal. Research is a huge part, and the most direct way you're going to see that is actually show up is in your asset allocation. Now, I'd like to think that asset allocation is a happy face, right? All the emoticons that are floating around nowadays. But the truth of the matter is that as soon as it morphs into a pie chart, it gets a little tricky. And so we're going to try and not make it as tricky. But when you have your conversations and your reviews over the next 6 months, over the next few months, whatever that time frame is, please make sure that you're talking around and that and make us responsible to talk to you around what's your allocation, because that's going to matter the most going forward from this point out. What I think is also important to recognize is from Sean's presentation, our tone has changed. We've become a little bit more positive. There's a couple things that I'll wrap it all in together for you about why we've become much more positive on a few things going forward. When you boil down the pie chart, there's really only 3 areas. Equities, known as stocks. Fixed income, known as bonds. And then we're just a little bit more professional than to put miscellaneous. So we use this fancy term called alternatives, right? Anything but. Alternatives are vital to the success of long-term investing, because what we have learned, and as I think all of you here have learned over time also, is stocks and bonds teeter-totter, right? Stock market goes up, the bond market goes down. Bond market goes up. There's this enormous kind of pendulum of money that swings back and forth between the two of them, right? When the risk is high in the stock market, the money floats out of the stock market, floats to the bond market. And when the bond market is uncertain, it floats back over where they can get a better coupon, they go back the other direction. So this thing. Alternatives are special because they don't correlate. They don't play that teeter-totter game. They in the classic sense, they dance to their own beat of their own drummer. They do their own thing, and that's really great for your portfolio in the long run. So how do we determine how much goes into everything? The first thing is exactly what I said a few minutes ago, which is we sit there and we hammer it out at a table, face to face, in coming up with what we call an investment portfolio summary or statement. We make a statement and say, this is how we think things ought to be looking for in general terms. We have a belief system that we go. We're privileged to have a guy like Hugh Hewitt come in, and we get to talk to him and use that kind of insight in building your portfolios. How special is that? And how exciting is that? Then we use rebalancing. Rebalancing is this act of, it's a very, very natural act, but it's the only way that it really works in the long run. You sell, buy, with conviction. With conviction. But rebalancing makes us sell high and buy low, right? That's the right thing to do. We're going to see some opportunities here in the next few minutes about how to do this. Now, I'm going to break down all of these things, but when you really break down the blue section and you look at what really the equity section is, the 2 major categories are U.S. market, we know very well, and then the non-U.S. market. Now, I'm going to dive into that just for a second in another slide, a little bit more, but I want to give you a brief overview of what we're looking at. On the fixed income side, there's cash, CDs, money markets. That's a cash position. But then it also goes into things like the U.S. bond market. Now, let me give you a little sense about the U.S. bond market. The U.S. stock market is about $17 to $20 trillion on any given day, probably closer to 20 now that it's run up a little bit. The US bond market is 10 times bigger. You have the non-US market of bonds is even 10 times bigger than that. So, I mean, there's enormous amounts of money floating around in bonds in the world. Bonds can actually drive the stock market very well. Bill's going to jump into the orange section, which is called the alternatives, and going to spend some great time on that for you. So we're going to dive in real quickly. But what do you need to think about, and how are we going to think about things going forward real quickly? The U.S. and the non-U.S. stock market have different categories. There's large cap, mid cap, small cap are all U.S. based, and then in the foreign markets we think about developed markets and emerging markets, and the allocation of how much do we put in each of those. Well, as we break those out and take a deeper look at them, the thing to understand is that there's one big differentiator between the U.S. market and the non-U.S. market: currency. Currency makes a huge risk. We've had, as the quantitative easing of the last few years has really been a tremendous advantage for international investing, because the dollar's been going down in value. And so when we invest foreign and we come back to the United States, it's been an advantage to us because we're buying dollars back cheaper. Dollar's been declining over the last few years. Well, over the last few years, all the other countries have decided, hey, wait a second, the United States has been devaluing its dollar. Let's do that too, and we're going to race to the bottom. So now Japan picked it up, and now Europe's talking about doing it in different places. So currency risk is higher on international today than it ever has been. That's a change in the last 6 months, and that's something that we have been talking a lot about in our firm. So currency risk is the biggest differentiator, because if you invest $100 abroad and you make 10%, so great, you make $110, you have $110, but you come back to a 12% currency loss, you're really down too, right? So that's what we have to think about. That's the new risk in the international we haven't faced before. The other thing is the U.S. stock market has been very fractured this year. The S&P 500, as Sean was showing earlier, the S&P 500 is up about 11 or 12%. There was a pretty big decline along the way. There was a pretty big decline, that deep V, in which everything turned on a dime right there. But the Dow Jones Industrial 30, which is actually the longer term index that everyone's been using, that thing is only up about 6%, about half as much as the S&P 500. Here's the fascinating part. The Dow Jones Industrial 30 is in the S&P 500. Every stock in the Dow is in the S&P, because the S&P is just big. You have to be big to be in it. So somehow there's been a real disconnect between what's happening in the S&P and what's happening in the Dow. And so what it is very specific sectors of the S&P are doing very, very well. Utilities, for the first time in 5 to 8 years, are doing really well and driving most of the S&P return. Why? Lower gas prices, lower oil prices suddenly. How's our selection been doing? Well, we own, a lot of people in this room own something called Putnam Capital Spectrum, one of the most broadly owned things that we have in the portfolio. Putnam's done okay. It's a little bit under the Dow on a year-to-date basis, maybe underperforming slightly, which makes us think, do we want to replace it, right? We're all about asset allocation. We want to have the best performance. But here's the thing to think about. We always think about a cycle. We're always thinking about how you will perform and how your portfolio performs in a cycle. Last year was a great thing. This year is part of that same cycle. So we take a little bit longer look at it, and all of a sudden, where the S&P is up 45% over the last 2 years, Putnam, you can't see that possibly, but you'll have to take my word that you can take a look at it later, it's up 55%. So over the cycle, it's doing much, much better, and we want to continue to own it because we know that the selection, there's no manager change. We look at all the stuff, we feel really good about it. So one of the things that we talked about at the halftime report is the opportunity to go international and spend more time on the international side. We think that this makes a lot of sense because if you notice, there are times, the red line is the United States and the blue line is Germany. Well, there's a lot of times when there's a, let's call it a variance, right? They work together and they end up in the same place a lot of times. But particularly when Germany underperforms a little bit, it comes back up and we capture that return. In the halftime report, we saw this gap opening up and we're like, wow, this is a great opportunity. We can buy the cheaper region and we can also move and then have an opportunity for better growth for our clients. Now, I'm using the ETFs, exchange traded funds, for the example on this, okay? So we took a look at this, and let's roll forward. Well, unfortunately, Germany went into a bigger slide, and so we just know that it's going to come back over time because we've always seen that those lines converge again together. But instead of coming back sooner, it's going to come back a little bit later, and that's okay. How have we done in light of this? Now, these are the exchange-traded funds, and we often get questions from clients, hey, money guys, why don't you use exchange-traded funds more? They're cheaper, they have risk controls you can do. It's a better way to manage money. And we say, well, there are times that we may use an exchange-traded fund. But, this is showing France is also, Germany is not the only thing. The only one that's down, the whole region's down. But how have we done on our selections? This is one of the most broadly owned things we have in the firm. It's called MFS International Fund, right? It invests outside of the United States. Well, where the rest of the world is down about 10 to 12%, our MFS fund, our actively managed portfolio, is actually up 2%. So instead of being down 12 or down 10, our selection in this place picked better stocks because there was humans involved and they did research. They picked better stocks, and we're not down 12%. We're up 2%. Now, 2% may not feel like a big win, but I love the fact that I'm not down 12 for you, right? And we eliminated, the big thing is we eliminated so much risk through the selection process and the research that we were able to do. That's the big win, I think, for you guys, and what makes us feel really good is that we've eliminated. The other one that we do is we abbreviate it by Oppenheimer. Another broadly one owned in the firm is called Oppenheimer, Developing Markets. Developing, not the big ones. That's up about 2%, same story there. And then occasionally, we even find one that does particularly well because we picked a theme. This theme that we developed inside the firm is called global infrastructure, that there has to be a rebuilding of things across the world and a global construction infrastructure. This is called Deutsche Bank Global Infrastructure Fund. It's called TOLIX, T-O-L-I-X. That's up 16% for the year. A great thing to talk about, and one of the few things that is really outperformed nicely. So another selection out there. I'm going to rush through fixed income because I'm getting waved at it from the back of the room, but which is always fun. But the fixed income side, we have cash, U.S. bonds, and non-U.S. bonds, money markets we talked about, inflation-protected bonds. This whole section has been a disaster for the better part of 4 years because quantitative easing has made interest rates so low, and that they've driven interest rates so low that there's really nothing to be had. And international bonds, again, that's when Hugh Hewitt was talking to his economists that he had on the radio. This is what Hugh said he had 17% in, right? And this is what he was talking, I have 17% in international bonds. Well, again, why would you want to get out of it? Well, if the dollar's going to start strengthening, that's going to be a tremendous headwind in the currency play. So that's what's going to be the big problem going forward is currency. So, again, we would advise them the same thing. We're not doing a big thing in the international bond space right now. And if we are going to buy anything in the international bond space, it must be hedged. Hedged meaning it must be immune to what happens in currency. There are funds out there we can buy, active funds that we can buy that would be immune to currency. They take that risk out of the portfolio for you. Because bond returns have been nothing. I mean, short-term corporate bonds, usually one of the safer places to hide out, down 2.5%. The floating rate funds have done zero. And even that's after dividends and returns. And then the only thing that's done modestly well is 3% on the U.S. government ag is the large 10,000 bond aggregate. The problem is to get 3%, I got to risk 10%. I don't want. What kind of trade-off is that? For a hard-fought 3% return, I'm going to risk 10% of your principal? No way. It's not worth it. So that's why we've really been, as much as possible, down on bonds. So at the halftime report, if we had the pleasure of entertaining you there and having a chance to address you there, this is the chart that we showed at the halftime report about where we want. Green, upward arrows showing where we're going to spend more allocation. Red, downward arrows on where we're putting less allocation. There is one change, and you've heard some of the themes today about why we would make this change. You know, we have a new change in government, which could bring tax reform and put more money into Americans' pockets. You're going to hear a lot more from Bill here in a few minutes, but one of the most exciting things as an economist for the last 30 years that I'm excited about is cheap oil prices. If you notice, in October, when we were down 10%, all of a sudden oil prices went from $110 a barrel to $75. It wasn't a very graceful fall, but boy, it was a great fall. And you're noticing who's paid less than $3 for a gallon of gas recently. When was the last time you remember that? Been a while, right? On an inflation-adjusted price, it's cheaper than when we were a kid. Gas is cheaper now than it was when we were paying 25 cents because inflation would have pushed it up. It's tremendously good stuff. That is more powerful in the economy, by the way, that is more powerful in the economy than any tax break any politician can give you because it goes to everybody and it affects everything from food, cars, automobile, manufacturing, and products because all of it comes from oil. And so that is a tremendous boon. So when you have tax breaks, cheap oil, and maybe a change in government coming up here in the future, things are exciting. So what we do, watch. Okay, a little change. So we are going to emphasize the United States a little bit more going forward. Before we had about a 50-50 allocation between the United States and foreign. Today we're going to probably put it a little bit closer to about 60-40 or 75, depending on your situation, your needs, and where you're at in your personal situation. But we are going to underweight a little bit because of that currency risk going forward, and because the United States, the opportunity in the United States looks really good for the going forward for the first time. Everything else is kind of about the same as far as the allocation, and in all cases it's personalized for your circumstance. So. Quickly, when you study, as long as all of us have, hypothetical allocation of 60-40. 60-40 has kind of been known as the perfect balanced portfolio. There's a million stories about the 60-40 portfolio. Here's how it would look in your personal situation. 60% in equities, 20% in fixed income, and 20% in alternatives. That's classically somewhere plus or minus. A lot of people in this room have an allocation like that. Breakout 60% in equities means that you have 50% in U.S. and 50% non in the United States, right? And then on the fixed income side, you have 20% in anything that's paying zero, right? The fixed income side has done absolutely nothing. And then in the alternative space, you have 20%, and most of those things down there pay about 6%. So how does that look in a portfolio, and what kind of returns are we going to get because of that? So let's add it all up. The equity position, your U.S. equity position, you had about a 10% return on a year-to-date basis using the index, the higher number than a lot of us have even gotten, but that's fine. 30% of your portfolio is in that. It has a portfolio impact of about 3%. Then our non-U.S. allocation, we allocated for 2%. Now, if we were using the indexes, we would be down 12, and it would turn this whole thing upside down. But we use 2% as a positive number and stay positive with this. And 30% of your allocation went into that gives a 0.6% portfolio impact. Bonds, 20% of it, but unfortunately, it's really returned nothing in any way, shape, or form. So we got a 0 on that. And then these alternatives, which Bill's going to take us through here in the next 30 seconds. He's going to take us through a great explanation on alternatives. REITs and BDCs, business development REITs. Who can tell me what a REIT is? Real Estate Investment Trust. BDC, Business Development Company. That's right. So 6% return there, 10% of the allocation gives you 0.6. So you add it all up, a diversified portfolio is going to get about a 4.8% return in today's environment, and that's what it's going to look like. So it is a complex story. It is something that we can talk about, but we'll always, if you ever hear us on the radio, we're talking about the meatball. This is the meatball, because half of us are Italian, and we just like to talk about meatballs. I am Italian. I like to talk about meatballs. So with that, it is my great pleasure to take you through the orange section of the meatball, which is Bill O'Connor's specialty today to talk about, which is going to be taking us through some of the highlights of the alternative space. But with that, I want to thank you for your time. Thank you for your participation today. It's been a great honor to be with you. And all of us will be here later on for questions, and there'll be a Q&A after Bill.
Okay. We're right here in the alternative space. We talked about real estate. Now, REITs are real estate investment trusts, but you also have real estate income trusts. There are two different types of REITs. And the income trust, essentially we're the lender, we're the bank. We're going to make loans on property. We're going to collect interest, points, prepayment penalties. We're in it for the income. So a REIT that's doing that might be paying 6 3/4, guess how much you're going to earn on it? 6 3/4. Okay? Now, if you go into a REIT that's a real estate investment trust, we'll earn interest because we own the property, and our interest might be 5 to 6.5%, but we're also anticipating some rise of value of maybe 3 or 4% a year. Commercial properties aren't like California homes. If one went up 20% in a year, it would be just shy of a miracle. 3 to 5%, basically whatever inflation is pretty much, it's called net operating income and NOI, and it's a whole calculation that says here's the value of the real estate based on the income it produces. So that's those two items. But you can invest in real estate. There are programs that are office programs, residential programs, not that many residential programs, only two that are worth looking at, one being blue-collar apartments, because these are permanent tenants that keep paying higher rent every year. They don't go out and buy homes and leave us with vacancy factors. We don't like Irvine apartment buildings. Okay? Warehouse space that you have. Assisted living. We're going to talk about that in just a minute. In the resource space, and we love natural resources at times. We're going to talk about the gas issues here in just a minute. So when we look at the real estate, and there are different ways, notice that there are traded REITs. So there are some programs that you can go out on the marketplace and you can buy that particular REIT any day the market's open. Those are publicly traded programs. You have the non-traded programs that are public programs, but they're not yet on an exchange. And typically, the non-traded give you a higher income because what happens is once they trade, people will bid the price up on the stock so that the yield on it is lowered so it competes with everything else that's in the marketplace. So typically, you'll see us talk more about the public non-traded than you hear us talk about the actual traded REITs. And again, what's kind of new is down in here, the apartments and the healthcare. Apartments have been around for a while. There's really only one good program. Well, I got to be careful I say this. In our humble opinion, there's only one good program on the apartment side at the present time. There's probably hundreds of them out there. But remember that first, we've got 42 analysts back in Boston, down in San Diego, that vet all of these programs to say, these are the half dozen that we will allow. And then your money guys sit together and we go, well, yeah, we like this one and this one and this one, and we're not going to touch the others. So it's a whole vetting process that we go through in order, before we talk to you. Now, this is not going to be a surprise. There's 70 million baby boomers. A few of them are in this room. Okay? As of January the 1st, 2011, that was the first baby boomer to turn 65. Since then, and for the next 19 years, 10,000 boomers a day will hit 65. What does that mean? That means right now, out of 47 million, we are 14% of the baby boomers. 14% of that total, of the people over 65. See that grows? Now, it kind of gets out here to a limit because there are only so many of us. And once all of us have hit the 65, we're going to be almost a fourth of the population. Keep in mind, that's a big voting block. So we've got a lot of power if we can just get our act together. What does that mean is a probability of living longer. Now, if you're a single male, 65, get your will in order. Because a single male, by the time you get to 70, the odds of getting to 90 is only basically 1 out of 3. However, those of us that are happily married, happy wife, happy life, okay? So married couples, at 70, the odds are 30% of us, one of us is going to live to 95. Now, when Hugh asked if I was going to retire, And I said, I don't intend to retire. That means that you're going to have to put up with me for a long time, because I'm one of those happily married characters. Why she puts up with me, you have to ask her that question. Supply of housing. This is a huge trend. When you look at, we're growing older, we're living longer, more and more are going to end up going to assisted living, congregate care, heaven forbid. A lot of us are going to end up in nursing homes. But when you look at what's happening, they're just not building that many more of them. So if there is a reduction in the supply of something and an increase in the demand of the same thing, what might happen to the value of that? Might go up, okay? And that's what we're thinking also. When we get into there, we're not so much into those areas where they're dependent on government reimbursement. We want to invest in things where you've got private insurances and you've got people with the money to pay for it. So we're not going into certain types of housing because we want to have better returns. In the resource area, I got to go quick here. Commodities. How do you make a small fortune in the commodity market? Start with the large fortune. Okay. So okay. The man's right. When you're right, you're right. So the commodities, and the problem with commodities, and there are different ways that you can invest in commodities and in resources. You can't go in the futures market, and that's where, what was it, Trading Places. Remember that movie? Eddie Murphy, okay, and anyway, we won't go into the whole movie, but remember they were in the futures, and the futures is a zero-sum game. If you win, somebody lost. That's just the math behind it. And the problem is you've got a lot of leverage, so you've got to be really careful on the futures. You can go into options. Now, the nice thing about an option is what's the most you can lose when you buy or sell an option? The premium you collected or the premium that you paid. But you can still end up with a small fortune in the options. Then you have ETFs. Now, the nice thing about ETFs, electronic traded funds, you can decide when to buy, when to sell. You're not leveraged. And if we were to go into commodities, we would probably end up using some form of ETF. We would not be using futures and options. Then you have natural resources. Metals, liquids, and ag could be a resource. It could also be a commodity. It just depends. Put it wherever you want. Right now, and you guys know, Hugh's asked us almost every time we've been on the air with him for the last 5 years if we're gold bugs. The answer is no, we're not gold bugs. We've never been gold bugs. We're never going to be gold bugs. We're never going to tell you put all your money in gold because it's never gone to zero. Anywhere we're going to tell you put all your money in the stock market because it's never gone to zero. Or put all your money in real estate because it's never gone to zero. That's not the point. The point is, when is it the right time and how much? What's the allocation mix? Metals are now at a point where they've gotten low enough that we're starting to look at it to see whether or not it makes sense going forward over the next year to put 3 or 4, maybe 5% into metals in general. Not gold, metals, copper, aluminum, palladium, platinum. Ladies love the platinum ones, by the way. Okay, liquids. Yeah, that's part of the natural gas picture. This is very important. Now, if you get nothing else out of today, at least from the part that I'm talking about, these are financial manias, and every financial mania, and we're going to show you a couple in just a moment, goes back, and it basically starts down here in the kind of the stealth phase where it takes off, and the smart money kind of gets in first, and then there's a little awareness, and the institutional people start going, and you get this first little sell-off. Okay, that's a little bear trap, and then you see this media attention, enthusiasm. Public finally gets in around here, and then you get that greed thing going. Then you get kind of delusional. This time it's different. Okay, you've heard that once or twice in your life. Then you have this little dip, and you go, oh, well, that's it's just a little dip. It's a little mini correction, and then you have what's called the bull trap because you get this little bounce up, and you go, oh, maybe I should buy more. It's dipped. And then you have the capitulation. The problem is this keeps repeating itself. This is 1634. Now, granted, that's before our time. The first one that we have documented is the tulip bulb craze. That followed that same pattern, little dip, and then it crashed. Now, because we're so smart, it did take us about 50 years to repeat. And then you have the South China Sea, and you can see that same configuration happen, and then the dip. Now, by the way, after it finally capitulates, there is a second coming. It does come back up. Okay, but you definitely want to be careful how you do that. This is the commodity index, and notice how, and this is back in the 40s, we had that, came way down, then you had it again, came way down. We are just experiencing it, and it's come way down. This now has our attention that maybe this correction is getting close to being over. Now, we're not going to go out and buy anything. This, if you didn't know what this was, does that kind of look like that same chart pattern? Kind of sort of the same? This is the NASDAQ. This is the tech wreck that we've all experienced. We were there for it. So we want to be careful as we talk about alternatives that we're looking at price movements and that we're not in the middle of one of these manias as things seem to be heating up a little bit in the commodity, the resource space. The nice thing about the resource space is with this correction in the petroleum market down into the mid-70s. Now, does that mean it's going to get into the 60s? Our fear is it gets below 62. And the reason for that is natural resources right now that we have a glut in. Let's fast forward a little bit, down here in the liquids, right here. And you guys, some of you have seen this chart. And this was in 2011, and this shows the Canada, how much natural gas we have up in Canada, all the extra things they have found with us. And what's interesting is now look at it, it has expanded again by almost a third. So now we have more than we ever knew we had. And what's the problem with supply? Oversupply can create drops in prices. The reason we're keeping our eye on the petroleum, on the liquids they call it, is if that gets down into that 72 range, we got to really watch it. If it gets south of 70, what can happen is a lot of these shale plays end up not being profitable if oil gets too low. So even though we've got a ton of it, doesn't mean we're not necessarily going to be producing it. So although we love the play, we don't necessarily want to get wrapped up in it too deeply. And when we look at it, this is the upstream. These are the people that are drilling. They're the ones, whether it's an Exxon or an Atlas or anybody like that. We're not in here because we don't want to worry about the cost of the production. We love the midstream. And the midstream is the transportation, the processing, the storage. Who's been across the Golden Gate Bridge at least once in your lifetime? Okay. Did you realize that if you're leaving the city going north to Marin County, there's no toll? But what happens when you want to come from the north to get into the city? You pay a toll. Do you own the bridge? No. Do you own the toll booth? Would you like to? Yeah. That's a midstream. We don't own the bridge. We don't own the cars. We own the toll booth. So as long as it's being produced and it's flowing, and the infrastructure, like the Keystone Pipeline, as long as that's getting built out, and that's true in Europe too. I mean, it's not just the U.S. That's why we like that piece of it. Business development companies, we talked about that briefly, and most of you know I'm a recovering banker. Don't hold that against me. We made decent loans back when I was a banker because the BDCs now are taking the place of the bank. Business development companies basically take the money from us. Each of us give them, $1 bazillion. They, in turn, loan it to private companies inside the U.S. that we collect the interest from that comes back to the BDC, that comes back to us. And they have to pay out 90% in order for them not to get taxed. So it's a really unique tax vehicle that it's not a two-layer of tax like most corporations that pay dividends. Corporation pays the tax, then we get a dividend, we pay a tax. With these programs, there's no tax at the corporate level. So there's more money for us. We like the concept. Okay, now we're going to throw it open for questions. I had one that was given to me. What percentage rate of return on this year's market do you expect? Remember, Tom had the chart that said 4.8%. Keep in mind, that's where we are year to date based on what happened with the European issue that didn't pan out the way we thought. Over cycle, most of those balanced accounts that we have are all 6 to 9%. So we're at 4.8. We still have 6 weeks to go. The market's responding. It's coming back up. We might still hit our 6% target this year. We might be a little bit shy. Last year, you guys were thrilled with the results last year. So if we're off a little bit this year, wait till next year. Okay, remember, 3-year cycle, 3 to 5 years. That's a market cycle. So we still expect over time for that 6 to 9% should still be a good average for low risk. Keep in mind, we're trying to control the risk as much as we're trying to get a decent return. Now, the one thing we didn't get into in January, we're going to talk about, you've heard these programs that talk about market-like returns, but your principal never goes down. You've heard that? Of course you have. You listen to the radio. You've heard a lot of people are saying that. In fact, there's a presentation going on next door about that very thing. So if you get really bored with us, yeah, go next door, sit in, take some notes. They're called equity indexed annuities. And basically what it does is it gathers your money and it puts it into a fixed account. And if the market goes up, you gain. If the market goes down, you go sideways. So I will tell you now, who wants to know how it works? A couple people want to know, okay. Each one of us in this room is going to put in $1 million, except for me. I'm going to run the thing. This came out in the Great Depression. It came out in the late 30s. I don't remember what year, where the Rockefellers and whatnot got together and said, we don't ever want to have another loss like that, ever. What can we do? So they gather the money, and let's say there's $100 million in this room. We put it in a pool, and we go buy treasury bonds. Are treasury bonds going to lose value? We're going to hold them to maturity. Government's going to write a check. They're going to pay it off. Don't know it's going to be worked. Not important. Your principal is now safe, isn't it? Unless the government fails. Not likely to happen even with the current occupant in the White House. What do we collect from those bonds? You have to understand, if I ask a question, you have to answer. If you ask a question, I will answer, okay? That's the implied agreement we have here. Okay, we collect interest. Thank you, Lex. You saved the entire room from a lashing. So let's say it's like today. It's just a 3% number. So on $100 million at 3%, the mathematician, see, this is where we need Robert. Okay, how much interest do we collect at 3% on $100 million? 3 million? Is that right? Okay. What could you do with $3 million? Spend it. No, this is an investment. You take that interest and take half of it, or 2/3 of it, and you buy options on the market. Now, if you buy options, remember we said with options, the worst that can happen is you lose the premium that you paid for the option. You don't lose the principal. The principal's still $100 million in the treasuries. So if the market goes up, what happens with that option that we bought? Goes up in value. Are we happy or what? We take those gains, and what do we do with them? No, you don't spend them. You buy more bonds. So the next year, we now have $115 million we can buy options with. So year after year, that's repeated, so the principal was never at risk. And that's essentially what the insurance companies are doing is they're gathering all of our smaller amounts, they're pulling it together, they're buying treasuries for them, they're getting options with the premium, and that's how they can say if the market goes down, you didn't lose a dime. Because you didn't. All you need is a bunch of money to do it with or an insurance gain. Here's the problem. When rates are low, you don't get much earnings. So you don't have a whole lot of money to buy the options with. And when there's low volatility like there is today, the option premiums are small, so you don't get the bang for the buck. When you see interest rates get back north of 5.5%, you will hear us talk more about this concept. Because right now, these programs are paying you about 2.5% to 4%. Granted, market goes down, you didn't lose any money. Now, you can get 2 to 4% with safety. or you can get 6 to 9%, have a little bit of risk, and you get to choose. We're happy with either choice because we get our management fee. Okay? Doesn't matter to us. We're just trying to get the rate of return that is what you need for your family. I don't care what the market does. I care about the O'Connor family rate of return. What does my family need? Care about the Mantley family return. Marcel's back there telling me shut up. I know he's telling me to hurry up. So we can do that, and we'll talk more about that come January. Okay, a couple quick questions, and for right now, though, write down January 31st. Mark your calendars. It is a Saturday. Dr. Mark Skousen, a renowned economist. He's in the category. Remember, you heard Hugh talked about Brian Westbury. Brian's the chief economist for First Trust. Mark's written half a dozen books. He writes newsletters. He gives lectures. He's from the Austrian School of Economics, which was the only economic theory that properly predicted the Great Depression before it happened. He's not a Keynesian, and he's going to give us an economic overview for next year, talking about certain economic numbers. So make sure you write that down. By now, I've talked long enough that you've got your forms filled in. Okay, questions. Guys, come on up just in case. Either we were so good or you're just tired and want to go home. Either way is good. If you're embarrassed to ask a question, then you can write it down and see us afterwards. We have one brave soul over here.
Basically, what we're talking about is productivity number. Americans have become, as we've always been, to our core, most of us have been very productive, industrious people. That's why our grandparents and their grandparents came to this country. And that's why we draw a lot of entrepreneurs to America. Now, does that come and bite us in the butt? Because we are so industrious, we're going to give away our productivity to a company and let them take advantage of us. Well, a couple things I would say. One, that only runs so far. Physics is physics, and they've proven time and again, at least Newton did, you can't always do more with less. It's impossible. We hit that inflection point. And I think that we've hit the point where the companies have become very efficient. They found out what they can do with certain levels. And if they want to grow, and they do want to grow for sustainability reasons, they can't always pass on more price increases to the consumer or to whoever they're offering services to, because the consumer won't tolerate it. So they have to have, and there's a ton of cash on the balance sheet. This goes to the other conversation that we're having about repatriating funds. There's a ton of cash on the balance sheet. Right now, companies are forced with the decision. How am I going to reinvest this? I need capital improvement. I need to improve my workforce. I need to improve the computer systems. I need to improve my own internal corporate infrastructure. And we did have the Goldman Sachs people in. We grilled them about this very subject, and we are starting to see now there's a push and pull about salaries in the workforce. It's just starting. We're on the cusp of it. But you cannot have the improved growth that we're talking about because we all know that a lot of those numbers are cooked. You can't have a improving, sustained recovery without the workforce participation that we need. I think we'll still remain productive. I think, there was a lot of fat in the system previous, and I think it's forced managers to manage better, but I think we'll still see that improvement. We'll still see American productivity, but we'll see that growth because corporate executives don't get paid without it, managers don't get paid without it, and I don't care if you're talking about divisional vice presidents or the manager at Burger King. They want to see improvement, and they're going to hire more folks at more generous salaries going forward, because now if I don't like working for you, I'm going to go over here and work for them because they're paying better. And you know what? That's going on right now. We're seeing the cusp of it, but I think we should see a lot more of it going forward.
On that same issue, keep in mind that manufacturing this year, for the first time in, 18 years, has actually increased, and part of that increase in manufacturing, which is bringing jobs slowly back, is the fact that we've got cheaper energy. And so now companies don't need to export employees where it's cheaper. If they have cheaper production facilities here, they can afford to pay higher wages and still end up with better profits by not exporting the jobs. So this whole renaissance of natural gas is creating a whole new cycle of potential homegrown manufacturing again. So you add all that together, and yes, it's going to cost more on the employment side, but it could cost less on the production side with lower utility costs. It's going to be an interesting dynamic. Yes, sir.
I'd say it's not necessarily the end number that we take a look at. We're not going to set the Fed funds rate. Somebody else is going to do that. We're just trying to give you the benefit of our tea leaf reading capability. I think what we do is we take a look at the trends more than the absolute number. We go into it with a jaundiced eye, like many of you do, in that we know that number is cooked. We know that there is a lack of workforce participation, that people just got so fed up, they left the workforce, they quit the workforce, and we understand that. We understand that there's duplication of efforts, that there are people taking part-time work right now, and they're doubling up because for economic reasons, they cannot have single part-time. Then there's the healthcare, there's the 30 hours. We could go on and on and on. But the underlying fact is that we do see a trend emerging. And whether the real unemployment rate is closer to 8 and 9%, it's better than it was. The feeling that we're getting from the economists are it's getting better. And sometimes, yeah, you got to use a little bit of Mississippi windage. But we like the trend that we're seeing. We like the conversations that people are having. We like the battles that employers are now having for talent. And that proves to a stronger economy.
I was just going to add also on we've deconstructed CPI, the Consumer Price Index, as well, and other previous seminars and things that we've given. I mean, we recognize that all the government numbers to some degree are cooked, right? We've deconstructed them and taken a look at them in this very format. So again, to Sean's good point, we look for the trend and not the absolute number in anything that we're getting from the government. And then remember also, the folks that we have coming into our offices are very bright folks, and they have their own numbers that are not cooked or not as cooked, right? So when we have the privilege to sit with guys who manage $1 trillion at Goldman or $3 trillion at Fidelity, they come in and sit with us and give us their insights. They're saying, yeah, the government's saying this, our numbers say this, and there's some sort of guide, two-star guideposts that we can use from that. So that's the power of the research that we do and the time that we spend on that research.
They've already done it. It's called Medicaid. And for those that can't afford private payment, the question is, what if the government takes even more control over the nursing home? And California is called Medicaid, other places call it Medi-Cal, different states call it different things. If you don't have enough money to private pay, you go on the state dole basically. It's already in place. It was in place before Obamacare, okay? And it's not going to go away. And if we have more and more less productive seniors, I think I said that right, then those roles will continue to expand. But it's limited as to what services you'll get, and it's limited as to what they can charge. So you're going to have, in our humble opinion, second class, third class services. We don't want that. We want to go into facilities where we have our clients that have enough money that they can pay the bill, and they're going to get, great nurses, good doctor, good care. You're not going to walk in and smell ammonia when you go through the front door. Okay, that's what we mean by private pay. If we have insurance, it's private insurance. It's not state insurance. Whether it's long-term care, and there are different forms of long-term care, and we'll talk about that at one of our future sessions. Somebody asked that we talk about long-term care.
You don't see the government taking those things over, maybe private
Even if they did, if you're private paying, you're not relying on insurance, it doesn't matter that they took over the insurance. which is a point we're making, is we don't want to worry about government interference. People in Canada, they've had socialized medicine for years. And how they can have socialized medicine and lower corporate tax rates, why can't we copy their tax rate? We're trying to copy their social insurances. Different question. The point there is, for medical purposes, they're coming across the border and private paying our doctors to get better care. So even though the government is, quote, in charge, there's still private payment going on, which is why we're after that private pay, not the government. Yes. What we said was, and Tom will speak to this, if you see liquids get below a certain level, the ability for the natural gas to be profitable is reduced. It's like anything else. There's a cost to bring it out of the ground. We're not involved with the cost to bring it out of the ground, so we're not as concerned about that. We're only concerned that they produce it. If they produce it, we get the transportation, the infrastructure. But there is an issue on will they keep producing.
And there was a question earlier for Hugh Hewitt about the Keystone Pipeline. Let's all understand what all is going on with that, because Hugh was too gracious to talk, not to sidestep the real issue. Keystone is a brilliant idea. It needs to happen, and eventually it will happen. There's not anything else that can be said about it, except that right now the reason it will not succeed going forward and dies on the president's desk is because we want to be in the transportation business, right? We want to invest your dollars in the transportation of gas and oil from point A to point B, which is what Keystone is part of. Well, there's a guy named Warren Buffett who is in the transportation business. He owns a thing called Burlington Northern Santa Fe. And right now, all that oil coming out of North Dakota and all the northern parts run on Burlington Northern Santa Fe trains. And so he has Mr. Obama's phone number and goes, you're not going to sign that thing. You're not going to sign that thing. And that's why Keystone's dead, is because it's not getting past Warren Buffett and his choo-choo trains. So we should wrap it in our humble opinion. So we should probably wrap it up and be available for individual discussions at this point.